On paper, the U.S. economy looks healthy. Unemployment sits around 4%, GDP continues ticking upward, and headlines celebrate job gains. But what if the recession you're watching for has already begun, and the official data simply hasn't caught up yet? That's what historical patterns suggest might be happening. Hey everyone, welcome back. Quick reminder, I'm not a financial advisor. This is educational content based on economic data and historical patterns. Always do your own research and consult licensed professionals before making financial decisions. Today, I'll explain why your wallet might feel lighter, even as the headlines insist everything's fine. I'll show you the same warning signs that appeared before major economic downturns in recent history. Let's get started. Here's one thing most people miss about recessions. They're almost always recognized after they've already started. The National Bureau of Economic Research, the official organization that dates recessions, operates with deliberate caution. They collect months, often 6 to 18 months, of comprehensive data before they'll declare anything official. So it's possible to be experiencing economic hardship while official measurements still indicate stability. History shows this gap happens regularly. Remember the 2008 financial crisis? The Great Recession actually began in December 2007, but the NBER didn't officially declare it until December 2008, a full year later. By that point, Lehman Brothers had already collapsed, and financial markets worldwide had crashed. Similarly with the dot-com downturn, the economic contraction began in March 2001, but the official declaration didn't arrive until November of that same year, 8 months after it started. This delay isn't due to incompetence. It's built into their methodology. They require absolute certainty before making official declarations. The downside? You may be living through a recession for months, possibly over a year, before any official confirmation arrives. Let's discuss that 4.4% unemployment figure that gets cited so frequently. On the surface, it sounds healthy, historically low, in fact. But what that number conceals matters just as much as what it reveals. The official unemployment rate only counts people actively seeking work, specifically individuals who've applied for jobs within the previous 4 weeks. If someone stops actively searching, they simply vanish from the calculation entirely. Since the pandemic, over 1.6 million Americans have dropped out of the job search completely. These aren't people who found employment. These are people who gave up. And the moment they stop searching, they're no longer counted as unemployed. The statistic improves on paper only. Simultaneously, labor force participation has declined by approximately 1.5 percentage points compared to pre-pandemic levels. So the headline unemployment rate can appear strong and healthy, while underneath, a steady stream of discouraged workers quietly exits the workforce altogether. The media celebrates a robust labor market, while people are simply giving up. Now let's examine job quality. The positions being created aren't equivalent to the ones that disappeared. Full-time careers with stability and benefits are being systematically replaced by part-time, gig-based work. And the way jobs are officially counted makes this troubling shift look like net positive growth. Here's the accounting mechanism at work. When one full-time position gets eliminated and someone scrambles to patch together 2 separate part-time gigs just to survive, government statistics record that as 2 jobs created. Net positive growth. Economic success. Even with this statistical advantage, 2025 only generated approximately 181,000 net new positions through the first quarter. Meanwhile, roughly 4.4 million Americans currently work part-time specifically because they cannot secure full-time employment. Yes, these individuals are technically employed in the official statistics. No, many are not making ends meet financially. Across the entire economy, stable positions offering benefits, security, and livable wages are disappearing, replaced by precarious work lacking health insurance, retirement contributions, or predictable income schedules. Income drops. Financial security evaporates. Yet the employment headline still reads healthy and strong. It's equivalent to claiming the housing market is thriving because people still have roofs over their heads, while conveniently ignoring that everyone downgraded from single-family homes into cramped studio apartments. Now layer on cumulative inflation, which has exceeded 25% since 2020, and the situation deteriorates rapidly for average Americans. To keep pace with rising costs, growing numbers of people are increasingly relying on credit cards, what I call plastic poison. This isn't discretionary spending on luxuries or extras. This is borrowing to cover fundamental necessities, groceries, utilities, rent. Total credit card debt reached approximately $1.28 trillion by the end of 2024, setting a new record high. The average interest rate on those cards now hovers around 22%. So when you hear media outlets praising strong consumer spending, understand what that actually means. People aren't spending more because they're earning more. They're spending more because they're borrowing more. Personal savings data confirms this exact pattern. Historically, Americans maintain savings rates at around 7 to 8% of disposable income. Currently, the personal savings rate has collapsed to approximately 4.5%. This is textbook pre-recession behavior. Households stretching themselves dangerously thin with debt to maintain consumption levels while real wage growth stagnates. It functions perfectly until it doesn't. We've witnessed this movie before. In 2007, financial media celebrated robust consumer spending right up until the moment everything imploded. Today's economy feels like it's operating on borrowed time, quite literally. The Conference Board's leading economic index, which is specifically designed to forecast economic turning points before they happen, has declined for 6 consecutive months as of early 2025. This is the identical pattern that emerged before both the 2001 recession and the 2008 financial crisis were officially declared. Corporate financial stress is mounting as well. Commercial bankruptcy filings have surged over 7% to exceed 24,500 cases, the highest level in more than a decade. Companies that survived on artificially cheap pandemic-era financing are now struggling under tighter monetary conditions and higher borrowing costs. Perhaps each individual indicator is simply random noise, or perhaps they're collectively telling the same coherent story. Labor force participation is declining. Job quality is deteriorating. Purchasing power is shrinking. Credit card usage is accelerating. Personal savings are falling. Corporate bankruptcies are rising. When multiple warning lights illuminate simultaneously on your dashboard, it's not a minor glitch. Something fundamental is malfunctioning. So why do official statistics still appear healthy when economic reality feels anything but? A significant reason lies in how we measure economic health in the first place. Many of our core economic metrics were originally designed in the 1940s and have been systematically modified over decades, often in ways that can obscure underlying problems. Take the unemployment measure. The official methodology treats someone working just 1 hour per week as fully employed. Drive for a delivery app for 60 minutes? You're categorized in the exact same employed bucket as a salaried software engineer with comprehensive health benefits and retirement contributions. GDP accounting treats consumer spending financed by borrowed money identically to spending funded by earned income. There's no distinction between sustainable economic activity and debt-fueled consumption. Then there's a principle called Goodhart's Law, which states, when a measure becomes a target, it ceases to be a good measure. Once policymakers, institutions, and markets begin optimizing for a specific headline number, that metric increasingly diverges from the underlying reality it was originally designed to capture. Rather than improving actual economic conditions, systems start gaming the measurements themselves. And that widening gap between metric and reality is precisely where recessions can hide, until they become impossible to ignore. We've gradually shifted from measuring the economy to managing the optics of our measurements. Over time, this creates a troubling divergence. The official metrics drift further and further from what people experience in daily economic life. The unemployment rate becomes primarily about minimizing the headline percentage, rather than genuinely improving job stability and quality. GDP becomes focused on maximizing output numbers, rather than enhancing actual economic well-being and standard of living. Even inflation indexes become targets to manage, rather than accurate reflections of real cost of living changes affecting households. None of this happens by accident. This is Goodhart's law playing out in real time across our entire economic measurement system. When metrics become targets, the system optimizes for the numbers themselves, not for the underlying reality those numbers were originally supposed to represent. The result is a widening gulf between reported economic data and lived economic experience. And that gap isn't accidental. It's precisely where recessions conceal themselves until they become undeniable. Many of these patterns are visible in current economic data, which is why understanding historical context matters. When the National Bureau of Economic Research eventually issues their official recession declaration, it won't be breaking news to people who've been paying attention. It will simply be delayed, bureaucratic confirmation of what everyday Americans already understood from their bank accounts and bills. Once you understand how these economic measures are actually constructed, you start asking fundamentally better questions. When media outlets celebrate job growth, ask about job quality. When they trumpet wage gains, compare them rigorously to actual inflation. Not the official CPI, but your real cost increases for housing, food, healthcare, and energy. When consumer spending appears robust, examine the credit card data and personal savings rates running underneath. The economy being reported in headlines and the economy people actually navigate daily can be dramatically different things. The real economy leaves clues everywhere. And right now, the constellation of those signals matches historical pre-recession patterns almost exactly. Deteriorating labor markets, expanding consumer credit dependency, collapsing personal savings, and rising corporate distress. So the pressing question becomes, how long until the official economic data catches up to reality this time? Look, I'm not trying to create panic here. I'm trying to create awareness, because being informed gives you genuine options. It provides time to prepare, to adjust your financial positioning, and to protect yourself before conditions deteriorate further. If you found this analysis valuable, definitely hit that like button and subscribe for more.